Good afternoon, friends. Welcome to this financial series brought to you by FFPAI in association with Finovet, a leading company in investment advisor. And they are also uh, giving advice to our FFPI investment also. If we summarize our journey so far, we have started this financial series since 15th December last year. And we have covered various topics like wealth building through equity and mutual fund, then how to planning for our tax effectively, insurance, uh, special taxation tips for doctors, and even tax planning for family physician. So this is our seventh webinar, and today we will be talking on CAGR versus XIRR. That is, if we invest in mutual fund or equity, whatever, but we have to retrospect our investment and the performance of our investment. So what is this calculator which is better? For that, we have an expert, Mr. Sagar Maheswari. I would like to introduce him in a very brief. He is a certified financial planner and also assistant vice president at Finovet. And his expertise is in retirement uh, uh, planning, and he has a vast experience of more than 10 years. And at present, assets under his management is more than 400 crores. So we welcome Mr. Sagar Maheswari, and I would like to start uh, the discussion. Over to Mr. Sagar.
Thank you, Dr. Deepak. Thank you so much. Good evening, everyone. So today we have connected for a very interesting topic, knowing which returns to look at when you are analyzing your portfolio, be it CAGR, XIRR, or an absolute return. So what we'll do is we'll go through some important points regarding various returns, understand what is the main difference, when to look at which kind of returns, and accordingly move forward. So we'll keep this session interactive. You can post your question maybe on the question portal or chat, and I think the team will be able to answer those as well. So before we start, and we discuss about which returns or what to look at. So currently, how are you measuring your the performance of your investments? If you can just write it down that which returns among these you look at to measure the performance of your portfolio. I hope my screen is visible.
So majority, I think, will check only profit they earn.
Okay, great. So most of the people only are checking profits. Some are checking maybe dividend yields, some absolute, and some XIRR. So we look at all the three returns, majorly the absolute CAGR and XIRR. What is the main difference? We'll also do some calculations around it. So what we'll be doing is step-by-step guide to calculating your XIRR, understanding the difference between both XIRR versus benchmark returns, how to download CAMs and analyze your mutual fund portfolio, and the tools and calculator to simplify the XIRR calculations as well. Okay. So what is absolute return? So absolute return basically captures a simple profit earned on your investment. So basically, if you have invested rupees 1 lakh and it becomes 1.5 lakhs, your return is 50%. So this 50% is basically your absolute return. So in absolute return, basically we don't consider the time horizon. That okay, at in which time horizon you earned, this one became 1.5. We just simply, the formula is also given, the end value, whatever is the current value of your investments, minus the amount that you have invested, divided by the amount you have invested into 100, gives you the 50 answer in this particular example. So this is a very simple and crude way of looking at, okay, my 100 became 150, so my return is 50. If 100 becomes 200, your returns are 100%. But the main challenge is that in how much time did this 50, 100 became 150. So in this example, let's say if 1 lakh became 1.5 lakhs over a period of 5 years, a simple return would be 10%. Right? So sometimes what happens is that we look at this 50% return and we feel, oh, our portfolio is earning a very good return. We are doing very well. But actually, if you look at year on year, what kind of a return your portfolio is given is hardly equal to a 10%. So from 50% coming straight down to 10%, the difference is huge. Right? So you need to know where you are seeing this absolute return or you are seeing the annualized returns or not. So the biggest challenge in absolute return is it doesn't consider time. Okay, time is of utmost importance. A return of 1 becoming 1.5 in 5 years is 10%. Same if it becomes 1 to 1.5 in 2 years, the returns are approximately 25%. Right? So you need to know the time to consider the actual annualized returns in your portfolio. So what considers time is your CAGR. Okay. So when we come to CAGR, so CAGR is basically compounded annual growth rate of your investments. It shows the average annualized returns you have earned over a period of time. Right? So let's say again in the same example, 1.5 lakh became 1.5 over a period of 5 years. The absolute return was 50, but the CAGR return will be 8.45%. Right? Because in this we are also considering compounding. So compounding means that let's say in the first year you invested 1 lakh rupees and you earned a return of 8%. So your portfolio become 1 lakh 8,000 rupees. Now in the next year, this 1 lakh 8,000 will earn the 8% interest. Right? So your interest is all, when your interest also earns interest, that is what we call as compounding. Right? So in this case, the main thing is the number of years. So current, how we calculate CAGR, it's very simple. Whatever is your current value divided by the amount that you have invested, raised to the power 1 by number of years. Okay, minus 1 into 100 gives you the CAGR calculation. Now this CAGR calculation, where do you see this CAGR calculation? Do you know where do you see these CAGR calculations? The CAGR calculations are usually visible on all the websites where you go and you check the mutual fund returns. The 1 year, 3 year, 5 year, 10 year, all these are basically your CAGR returns. So CAGR returns basically tell you that, okay, at the start of the investment period, what you invested, today, what is the current value? Considering the time, what is your compounded annual growth rate? Okay. So you understood the difference between absolute and CAGR. So absolute doesn't consider time. CAGR, it considers the time and tells you the average return for that time horizon. Okay. The problem with CAGR. So CAGR, looks good. Ki acha, okay. It's not telling you exact absolute, but एक time को भी consider कर रहा है. It is telling you, okay, this became that. वो भी हमें पता लग गया. But what is the problem in CAGR? The problem in CAGR is it does not consider periodic investments. Right? So ऐसा नहीं होता है कि in most of the cases we look at when we're doing, let's say, SIPs. SIP has become a very popular mode of investments. So when you're doing SIP, you are investing mostly on a monthly basis. So each month when you are investing, the cash flows are coming in. So बहुत बार ऐसा भी होता है, when you are investing, you invest for a certain period of time, you withdraw some amount, you again invest some amount, then amount can change. You started with a SIP of 5,000, then it became 10,000. So the amount also changes. So CAGR, the drawback of CAGR is that CAGR does not consider the cash flows in between the periodic investments that you are doing. Right? It considers the time. So what it will do is it will tell you from one point to another what was your compounded annual growth rate, but it will not consider the transactions basically you did in between the both the investments. Okay. So to take care of your periodic investments, the return that we calculate is your XIRR return. The XIRR return is also known as extended internal rate of return. It is used to calculate annualized returns of investments that have multiple in cash flows. So like I gave the example of mutual fund investments, right? So when you have multiple and irregular cash flows happening at different time horizons, different frequencies, different amounts, you usually calculate the XIRR return. Okay. So how do we calculate the absolute CAGR XIR? What we will do is we will quickly take an example in the Excel also. Okay. So I'll just share my screen and we'll go to an Excel sheet. I hope the Excel is visible. So we'll take again the same example. So we invested rupees 1 lakh. Current value is, let's say, 1.5 lakhs. Time horizon 5 years. Absolute return. So 1. So 1.5 lakhs minus 1 lakh divided by 1 lakh gives you 0.5. This return multiplied by 100 gives you 50%. This into 100 gives you 50%. Sorry. The percent again to 50%. Right? This is your absolute return. We calculate CAGR. So CAGR is calculated. So initial final value is 1.5 lakhs divided by the invested amount 1 lakh raised to the power 1 divided by 5 minus this whole minus 1 gives you a return of 8.45%. What we looked at in example. Right? Now to calculate the XIRR, what you need is, so let's say now we'll change the example a little. So let's say this 1 lakh that you invested, you didn't invest in one go. You invested over a period of 2 to 3 years, 5 years in different cash flows at different dates. Okay. So let's say you invested on 1st of January 2019. You invested 10,000. Then on 3rd of September 2019, you again invested 20,000. 3rd March 2020. Let's say we invested another 50,000. Then on 1st Jan, 2021, we withdrew. We withdraw some profits and let's say 30,000 we booked the profits. And now again and first April 2023, we invested 50,000 and today the value is 1.5. So in this thing, what you need to make sure is that these are the dates, these are your cash flow. Whatever you are investing comes with a minus sign. Whatever you get out is a plus sign. Okay. So this is one thing which you need to remember while you are calculating the XIRR returns. Okay. So when you calculate XIRR, so we give XIRR, we select the cash flows, we select dates, just hit enter, and you see, you know the returns 10.82%. So you see all three returns are showing you a different percentage as to what your returns are. Now the thing is, it's not that any of the returns are wrong. It is about what returns you should look at and when you should look at it. Right? So absolute returns, first of all, where do you see absolute returns the most? Do you know where do you see the absolute returns the most? In all of your demat accounts, maximum demat accounts, the returns that you see besides the portfolio value is your absolute return. The 20%, 30%, 40% returns, some people see 100% returns. So those are basically your absolute returns. What we have observed is that maximum demat accounts show you only absolute return. They don't even show you CAGR or XIRR returns. Right? So which sometimes becomes misleading because people think that, okay, I'm doing really well because my portfolio is doing, giving me 50% returns. But when actually it might just be giving you 8.5 or even less than that. So it becomes of utmost importance that you calculate your XIRR returns, because what happens in stock investments also is that you are investing at different points of time. You're buying some stocks, you are selling some stocks. So there are a lot of transactions which are happening. Cash flows are coming in, going out. So what you need to do is you can download your trade book from your demat accounts, plot it in the Excel, know the dates, plot the cash flows with the right signs. If you're buying, you can mention it minus. If you're selling, you can mention it plus, or vice versa, whichever you like. Put the formula of XIRR in Excel. Just select the values and the dates, and you will know your actual return. Okay. So it becomes really important for you to take the right decisions. Know that, okay, actually your portfolio is doing well or not. Is your portfolio beating the market, also beating the inflation or not? Because in a lot of cases we have seen that sometimes people feel that they are at 50-60% returns, but when their portfolios are not even beating the inflation because they have been investing for past 8 to 10 years and their returns are just 60%. Right? Ideally, if your portfolio is earning a return of, let's say, 12%, your money doubles every 6 years. 12% CAGR or XIR return, if your money is earning, your money should double every 6 years. Right? So if that is not happening in your portfolio and you are not looking at the right returns, you can go calculate your returns, check your portfolio, and you will exactly get to know where do you currently stand. If you're doing good, great. If you're not, you can take some help. Okay. I hope till now the difference in all three returns is clear. Any questions?
Question we will ask later on.
Okay,
Sorry.
fine. So now the main question is, so we have understood what is the difference between the three returns: absolute returns, CAGR, and XIR returns. Now what we will look at is that, okay, now I know कि कौन सा return देखना है, which returns do we have to look at, but how do we compare returns? Returns compare किससे करें? So to compare the returns, you need to know the benchmark of your portfolio. So is your portfolio beating the benchmark? So first of all, when you want to know कि portfolio benchmark को beat कर रहा है कि नहीं कर रहा है, you first of all need to know the right benchmark of the portfolio. So benchmark का मतलब क्या होता है कि let's say you are investing in a large cap fund. So the benchmark for that is a Nifty 50 or a Sensex. So benchmark is basically कि there is a standard index which represents the overall market or the sector which you are investing into, and which represents that sector, and you are comparing your portfolio with the benchmark. Okay. So in the investment portfolio, usually what we have seen is, if we consider even mutual funds or let's say even an equity portfolio, a lot of times we see that a portfolio is a mix of different categories, different market caps. So you'll have a large cap, mutual fund, mid cap, small cap, flexi cap, hybrid, debt, liquid, various kinds of mutual funds, right? Even in your stock portfolio, you would have, large cap stocks, mid cap stocks, small cap stocks, different kinds of stocks. So you need to know which, uh, what is the structure of your portfolio, and accordingly select the right benchmark. Sometimes there are not standard benchmarks which are available for you to benchmark your portfolio also, because your portfolio construction might be so that you are investing, let's say we take an example that a 1 crore, and if you're investing 1 crore and 75 lakhs is invested in a flexi cap fund and 25 lakhs is invested in a bond fund. So the ideal benchmark would be a combination of Nifty 500 TRI, which would be 75% representing the flexi cap portfolio, and CCIL bond index, which will be representing the 25 lakhs in debt mutual fund. So combination of these two will become the ideal benchmark of your portfolio, right? So benchmarks are different. There are various categories of benchmark. Benchmarks can be made customized also based on your portfolio. And then you need to compare, okay, is my portfolio beating the benchmark or not? A lot of times we have seen that people are investing in, flexi cap kind of a portfolio. They have large, mid and small, all the three caps, but they're comparing their portfolio with Nifty 50. So Nifty 50 just represents the large cap. It's not, large, mid and small. So it might happen that your portfolio is showing a good outperformance from the Nifty 50, because usually large caps are less riskier and the returns are also a little stable and a little less than mid and small caps. So you have taken higher risk and generating higher returns, but you're not comparing with the right benchmark. So you feel, okay, and my portfolio is doing really well, but it might happen when you compare it with the right benchmark, your portfolio might not be doing that, right? So to know the right benchmark is very important. To know, construct a custom benchmark, first of all, knowing the asset allocation of your portfolio becomes really important, and then accordingly selecting the right benchmark will help you in comparing your portfolio correctly, and then know and take calls on your portfolio that, okay, if I'm doing right or wrong. Okay. So the challenges is that XIRR, the challenges for XIRR are that it is very hard to calculate XIRR returns, because if there are too many transactions, if somebody has been investing for past 10 years and, doing transactions on a monthly basis, doing SIP for last 10 years, imagine the amount of transactions that would be there. If you are investing in stocks on a regular basis, you buy and sell on a regular basis. Let's say you are doing short-term investments, you are buying a stock, it goes up 30%, you withdraw, you again buy another. There can be n number of transactions. So what we have seen is sometimes that people, because it's too tedious and they are not very familiar with the numbers, it becomes very hard for them to calculate the XIRR of their portfolio. It is even harder to calculate the XIRR of the right benchmark to compare your portfolio performance. So portfolio का अगर आपने XIRR निकाल भी लिया, तो benchmark का XIRR निकालना बहुत मुश्किल हो जाता है, right? Because first of all, you need to know the right benchmark and then calculate the XIRR of the benchmark also. That exactly amount, if whatever amounts that you have done in whichever product, you would have invested the same amount in different in the benchmark also. then what would have been your returns, and comparing the two. So consolidated account statements are available from CAMS and K FinTech. You also get it from NSDL and CDSL for stocks. So which come in a PDF form which cannot be converted easily into Excel. So क्या होता है कि transactions निकालने के लिए you can generate CAMS and K FinTech. तो एक consolidated account statement आता है which is very easy to generate. We'll also show you how to generate that for mutual funds. So you can check it, but the problem comes is it comes in PDF. And when you go and convert, आजकल बहुत सारे tools आते हैं, but when you go and convert also, it is not very easily converted, right? So it is also important कि कोई ऐसा tool हो जहाँ पे आप you can upload and then obviously it can help you. And two, अगर ये सब आपने कर भी लिया, you do the first three steps. The fourth problem comes is to do this whole exercise on a regular basis to review your portfolio. We have seen that the biggest problem with people is that you don't have so much of time to do all these exercises, right? Time is constraint. Time is a very big constraint. So to optimize your time and to do things easily, you need some platform or a tool which can help you to generate or calculate the right returns of your portfolio on a regular basis, right? So what we have done is, so we at Finovate have bought a tracking platform for people to know the actual XIRR of your portfolio against the benchmark. So it's very simple. There are just three simple steps. You have to download your cash from CAMS or K FinTech, upload it on the tracking platform, and your XIRR returns will be in front of you within a few minutes, compared with the right benchmarks XIRR. Okay. So how do you download your CAMS or cash statement? So what I'll do is I'll just quickly show you, take you to a website of CAMS where you can go easily and download your CAMS statement and how to download it as well. So I'll just share another screen. So you can go to camsonline.com. The website is CAMS Online. So if you just search CAMS Online, you will see this My CAMS Online. You go there. You accept this. On the top, there will be an option for MF Investor. You click on MF Investor. And you will land on this page where if you scroll down in the statements, you will see the first option, cash, CAMS plus K FinTech, right? You click on this. So there are two options. You want just a summary or a detailed transaction wise. So you have to do a detailed, select the detailed option, which period you want to analyze the returns for. If you want since inception, you can select specific period. You can generate statements as old as even 2001 and before that. So if you're investing since long, just select Jan of 2001. You can select with zero balance folios, without zero balance folios. Ideally, with zero balance folios gives you a true picture, because if you would have redeemed funds totally from a folio, you can also calculate your actual return since inception for yourself. Okay. Mention your email ID. PAN is optional. You can mention, you cannot mention, it is fine. You can enter a password. And that's it. You submit. The statement will be sent on your registered email ID, which you have mentioned here, within the next 15 to 20 minutes or half an hour. Okay. Becomes very simple. You get the statement. You can know all your transactions in mutual funds. Another thing this statements does is that it helps you in knowing if any of your mutual funds are not showing here, then what it means is that maybe in some or the other folio, your email ID or mobile number is something is mismatched. Okay. So it helps in knowing about your folios also. transactions, profits, everything. Okay. After that, you can come on our Finovate tracking platform, which is et.finovate.in. We will send you the link also. You can come there, register, upload your statement, and know the XIRR returns of your portfolio. If you want to do it on your own, I have already shown you the way that you can download the statement, convert it into an Excel, or if you have less transactions, you can get your transaction statement from somewhere else. You can download it, put it in Excel, put the XIRR formula, which is equals to XIRR. It's very simple, and select the cash flows, dates, and you can know your XIRR return. Right? Okay. So what we learned today was, so CAGR, should be ideally used for one-time investments like real estate. So if you've done a one-time investment, usually real estate, you buy one time and then, obviously there are no major transactions happening. Yes, if you want to consider your rental income also in that, if you're getting any rentals out of it, you will have to calculate XIRR return. But if you've just invested in a real estate property and now you're selling it, you can calculate the CAGR would be a better comparison rather than the absolute or the XIRR returns. XIRR return should be used for periodic or irregular cash flows like mutual fund or stock investments. XIRR suits for that. We also learned that majority of the demat accounts show absolute returns in their portfolio performance. They don't show your the CAGR XIRR. They are showing you absolute returns. So please be aware that you need to calculate your own CAGR XIRR returns to know the right returns of the portfolio. And all mutual fund fact sheets and websites, they show you the CAGR returns over different time periods. Example, 3 years, 5 years, 10 years, which are the past performance and which does not match the investor's portfolio returns. So you would have seen a lot of times that you go and you check up, mutual fund online. The mutual fund is showing that in last 5 years, it has given a return of 20%. But when you go and look at your portfolio, your returns are maybe 10% or it is showing 30%. It doesn't match your actual returns. So ideally, to compare your mutual fund portfolio, you have to separately calculate your returns, your CAG, your XIR returns, and then only you will be able to know that is your portfolio doing well or not. We have seen a lot of times people just go and check the past performance 1 year, 3 year, 5 year, 10 year, and whichever fund comes on the top, you invest in that. But that is not the true picture. Because what happens is in CAGR, if a fund has done very well recently, किसी एक फंड ने recently बहुत अच्छा रिटर्न दे दिया है, तो उसका 1 year, 3 year, 5 year, 10 year, all the returns become very inflated और वो बहुत अच्छे दिखने लग जाते हैं, right? So it's very important to calculate the right returns of your portfolio, to know when to look at which returns and do the right comparison with the right benchmarks. Then you can take an informed decision about your portfolio, your mutual funds, real estate, or anything for that matter, even FDs. Okay. Anything you want to compare, know the right returns, compare it with the right benchmarks, and take informed decisions. Right? So that's it from my end. I think we'll take some questions.
Sagar, the first question, the YouTube
Yes.
chat, that we have received, is that people are asking what is the difference between direct SIP XIRR and the regular mode SIP XIRR. And before you answer that, I also want to kind of add similar question that what is SIP XIRR versus lump sum XIRR? Because that would probably go in the line of CAGR. So answer both.
Yeah. So see, lump sum, usually if you're seeing the XIRR is as good as your CAGR. So I'll just give you an example also. I think if we take an example in Excel, it will be much clearer. So I'll just go back to the Excel we were calculating. So let's say we invested on 1st Jan 2020. We invested 10 lakh rupees. Okay. And today the value is, let's say 25 lakhs or 20 lakhs. Okay. So when I calculate the CAGR, so the formula for CAGR was the ending value divided by the start value, which is 10 lakhs. We have approximately invested for, I'll consider for the ease of calculation, 4 years. 1 by 4. So it gives you a return of approximately 18.92%. Right? Now, if I calculate the XIRR of this, XIRR, okay, I select the values, I select the time. XIRR is, I'll just change the rate. Let's do one thing first. Jam 2024. So it will be exactly 4 years. So if you see here, we are seeing exactly the same, approximately the same returns. If the time horizon is same, because XIRR takes the exact days, so last example it was coming a little different because it was not exactly 4 years. But if you see, if we take 4 years in lump sum, usually it is XIRR and CAGR are same. But now when we include the cash flows in this, so for this kind of a calculation which we did here, it's very hard to calculate the CAGR because we don't know exactly कि 10,000 इसमें से कितना बना, because we did a withdrawal of 30,000 also in between, right? So in this case, you can only calculate XIRR, which is kind of your SIPs. So SIPs, you have to calculate XIRR is the ideal way of looking at the returns. Lump sum, yes, you can look at CAG or XIRR, it is the same. Second question, I think, was between the regular and direct. So regular and direct, ideally, if you are investing, the difference is in the expense ratio, not in the XIRR returns. XIRR is basically, it's a kind way of calculating the returns. It is a type of return. But regular and direct, because the expense ratio of direct is less than the regular, so there is a difference in the XIRR. Usually, of a same fund, the direct returns would be higher than the your regular funds. I hope this answers the query.
This Finnovate platform is free for all, or
Yes. It's totally free. You can come sign up and check your returns.
Okay.
There are no charges for that.
Okay.
Sagar, one more similar query which would help the audience is, let's say we are talking about mutual fund XIRR, etc. The same concept and same principle can be applied for stocks XIRR as well, or is there any difference there?
Yes, it can be applied similarly to stocks as well. The only thing with stocks is you need to know exactly your see, if you're calculating a return for a particular stock and you invested in just on one day. So let's say आपने टाटा मोटर्स खरीदा था आज से 3 साल पहले at whatever price it was, let's say 100 rupees जो भी उसका price था, and today you sold it, you didn't do any transaction in between. Ideally, you can calculate your the CAGR. Again, in that case, CAGR XR will come the same. But let's say you bought Tata Motors at 100, then you bought at 150, then 200, 250, then you sold at 300, some quantity, you booked some profits, and then you again bought more quantity at 350, 400, and you are holding it till the date. Then XIRR would be a better calculation. It will show you the right picture of what kind of returns you have generated on that particular stock. Similar thing can be done for a bigger size portfolio also. So if you have multiple stocks, I would ideally say calculate the XIRR. It gives you the correct picture. So yes, in stocks, you can also calculate the XIRR. XIRR is simply a mathematical, you can say, formula. It can be applied on anything which has multiple cash flows if we know the time. The dates are very important. So it gives you the exact returns even by calculating the days in between those dates.
One more question is there by Dr. Dinesh Neelani. Please explain difference investment in regular direct SIP mutual fund returns.
Can you sir repeat the question? Difference in
Investment in regular direct SIP mutual fund return.
So see, as I mentioned, direct and regular SIP mutual funds. If you, I would say, see, how I look at direct and regular is, if you are an expert, you think that you can do a lot of analysis. So I think maybe there is, you as sir mentioned, that a lot of webinars have already happened where they've told you how mutual funds you should invest in, how you should research and all. If you can do a good research, you know which mutual funds are good, you can do in-depth analysis, because there are a lot of things which you need to look in mutual funds also. So sometimes what we do is we just go and look at the past returns, which is not the ideal way of investing in mutual funds. I think at Finovate, what we do is we look at least 15 to 16 parameters and then we select a mutual fund. If you can do that, I would say you can, yes, invest in direct, because the whole purpose of launching direct mutual funds by SEBI was that people who can do it on their own, they don't have to pay a fee basically to somebody to give them advice. But if you are not able to do that and you don't know and you don't understand these terminologies, you are not very savvy with the financial terms, you can go for a regular mutual fund, which usually some advisor or a broker, mutual fund distributor would advise you and help you in investing and taking the right decisions. We have seen that a lot of times people who don't have proper knowledge and investing in direct mutual funds are not able to beat the regular mutual fund portfolio also through a proper advisor. So direct regular is totally dependent on what kind of an investor you are. If you are a very intelligent investor, informed investor, basically knowledgeable, and you can do continuous analysis and monitoring, yes, you can go for direct mutual funds. If you cannot do all these things, I highly advise you to go to an advisor, contact a financial advisor, somebody who can help you in taking the right decisions and investing in the right mutual funds based on the right horizon.
So thank you very much, Mr. Sagar. So take home message. Can you explain five to 10 sentence take home message for our viewers?
So I would say the main thing is, first of all, it is about being aware about what kind of returns your portfolios are generating, because especially in current times when the markets have been on a bull run, it is very important to calculate the right returns with the right benchmark. Because if your portfolio has generated, let's say, a 30% return in the last 1 year, be aware that the market has given around 35% return. So if your portfolio, you're doing a lot of things in your portfolio and your portfolio is not beating the benchmark, maybe you need to look at it. So how will you realize that is by, first of all, knowing the right returns and then comparing your portfolio with the right benchmark. Just, it's a very basic thing. If you just focus on this, do a right analysis. And if you are not very good with numbers, I would highly recommend contact a financial advisor. They would really be able to help you and guide you and make a huge difference in your overall portfolio, is what I would say.
Yeah,
As a take home.
thank you very much. In short, absolute return is a very simple thing to calculate, but XIR are written to be taken to know where you are standing and where your investment is standing, right?
Exactly.
So with
Sometimes
this,
easy things are not the right thing.
yes, yes. So very good explanation to particularly doctors fraternity, which are who are not accustomed to all this calculation, but you have done very good job, sir. Uh, so
Thank you so
thank you
much, sir.
very much, and thank you, Finovate, for this wonderful webinar. We will meet next time, and till then, goodbye. Okay.
Thanks, sir.
Thank you so
Our
much, sir,
pleasure.
for the
Thanks,
opportunity.
Sagar.
Do you want to say, sir, Mr. Chintan?
Yes, yes. I just want to extend, gratitude to Sagar. He has explained this well. on, because there are a lot of doctors which would make mistake in judging the right returns.
Yes.
They may be doing well, but they don't know how well or how not well they are doing. So that is very well identified and explained. And thanks, sir, to you as well, that you have provided us the opportunity to kind of make a difference in the doctor's life. They may be doing very good on their own, but to kind of give them the right tool is very important. So thanks for the opportunity, and like we have done for the previous webinars as well, we will come back with a new topic, and we will make sure that it is very much resonating to the doctors community and very much needed as well.
So till then, goodbye and thank you very much.
Thank you so much.
Thank you, sir.